The independent investment banking sector has traditionally been viewed as a high beta play on the broader macroeconomic cycle, yet the evolution of Moelis & Company suggests a move toward a more diversified, resilient advisory model. 2025 performance saw adjusted revenues reach $1.54 billion, a 28% increase over the prior year. This growth was not merely a byproduct of a rising tide in global mergers and acquisitions, but rather the result of a deliberate multi-year investment strategy in human capital and the expansion of the firm's advisory pillars.
The bear case for Moelis & Company centers on the firm's high sensitivity to market volatility, its valuation relative to historical norms, and the risk that the anticipated M&A recovery could be derailed by persistent inflation or geopolitical shocks. Macroeconomic sensitivity and interest rate risks. The pure-play advisory model that makes Moelis highly profitable during upturns also leaves it vulnerable during market dislocations. Unlike bulge bracket banks that have diversified revenue streams from lending, retail banking, or wealth management, Moelis is almost entirely dependent on the successful completion of advisory mandates. If broader economic conditions worsen, leading to a spike in market volatility or higher for longer interest rates, the firm's revenue-generating capabilities could face severe pressure. A clear example of this sensitivity occurred in March 2026, when shares of Moelis fell 6.8% in a single day following reports of geopolitical tensions in Iran. Such events can lead to a risk-off environment, where deal negotiations are paused and financing markets tighten, directly impacting the firm's quarterly revenue realization. Furthermore, persistent inflation, as evidenced by the hotter-than-expected Producer Price Index (PPI) report in early 2026, continues to rattle investors and could force the Federal Reserve to maintain high interest rates, which historically acts as a headwind for transaction multiples. Valuation premium and peer comparisons. As of early 2026, Moelis & Company trades at a valuation that many analysts consider full or even premium. The firm's trailing 12-month PE ratio of approximately 22.4 is higher than its 3-year, 5-year, and 10-year historical averages. A comparative analysis of peer metrics in March 2026 highlights this positioning. While Moelis boasts a superior ROE compared to Evercore and Hooligan Lokey, its market capitalization of roughly $5.2 billion is significantly smaller than its primary elite boutique rivals, potentially leading to higher stock price volatility and lower institutional liquidity. The bear case suggests that if the firm's 2026 revenue fails to meet the aggressive growth expectations set by analysts, who are forecasting annual earnings growth of 24.9%, the stock could face a significant derating. The talent retention dilemma. The war for talent remains a perennial risk for boutique investment banks. Moelis's compensation ratio, while improving, remains a central focus for analysts. The firm's adjusted compensation ratio of 65.8% for 2025 is a sharp improvement from 2023 levels, but maintaining this ratio while aggressively hiring in a competitive market is a difficult balancing act. If the firm is forced to increase its bonus accruals to retain key managing directors, profit margins could be compressed even if revenues remain strong.
The bullish investment thesis for Moelis & Company is built upon several reinforcing pillars: a resurgent M&A market, the scaling of the private capital advisory business, and the firm's unique culture of collaborative, senior-led advice. The multi-year M&A resurgence. The M&A market in 2026 is poised for a significant multi-year rebound, driven by more certainty in regulatory policies, the stabilization of interest rates. Strategics are becoming increasingly active as boards gain the confidence to pursue large-scale transformational deals to achieve scale and acquire technological capabilities. Industry data indicates that 72.6% of advisors expect deal flow to increase in 2026, with sectors such as technology, media and telecom, TMT, healthcare, and energy leading the volume. Moelis is uniquely positioned to capture this volume, given its exposure to M&A advisory, which typically accounts for 65 to 75% of its total revenue. The firm's ability to advise on marquee transactions underscores its premier brand status and its ability to compete directly with bulge bracket firms for high-value mandates. The Private Capital Advisory, PCA, fourth pillar. A critical component of the bull case is the build-out of the firm's private capital advisory business. Moelis has aggressively expanded this segment to serve the GP-led secondary market, which is experiencing record volumes as sponsors seek innovative liquidity solutions. In early 2026, the firm added several high-profile managing directors to this team, including Matthew Wesley from Jefferies and Kyle Wrighty from Barclays, both experts in private credit secondaries. While PCA revenue was limited in 2025 as the newly hired teams focused on mandate origination, management expects revenue contribution from this segment to increase meaningfully in 2026 as these mandates convert into completed transactions.
The integration of PCA allows Moelis to offer a holistic suite of services to its sponsor clients, encompassing primary fundraising, secondary liquidity, and private credit solutions, thereby deepening the firm's competitive moat in the financial sponsor ecosystem. Talent acquisition and the Moelis way. The firm's capital-light model is powered by its human capital. Moelis has demonstrated a consistent ability to attract top-tier talent from larger institutions, drawn by the firm's entrepreneurial culture and senior-led execution model. As of early 2026, the firm had 178 managing directors on its platform, including 21 added during 2025 and 13 internal promotions at the start of the 2026 performance year. The fact that 50% of the firm's managing directors were internally promoted is a testament to its commitment to talent development and a collaborative partnership culture. This internal mobility and stability are often cited as reasons why Moelis is a preferred employer in the investment banking sector, ranking among the top 3 firms in categories such as firm leadership, promotion policies, and business outlook. Company Deep Dive. The fiscal year 2025 was a period of substantial recovery and structural optimization for Moelis. The firm reported record fourth-quarter revenues of $488 million, reflecting an 11% increase from the prior year period. On a full-year basis, the firm's GAAP revenues reached $1,516.8 million, a significant jump from $1,194.5 million in 2024. This revenue trajectory was largely catalyzed by a 35% growth in M&A advisory services and a record year for the firm's capital markets business, which together offset a moderate decline in capital structure advisory as the market shifted from restructuring to growth-oriented transactions. The operational narrative of Moelis is increasingly defined by the firm's ability to generate significant operating leverage. For the full year 2025, the adjusted pre-tax margin improved to 21.5%, up from 16.4% in 2024, a 510 basis point expansion. This improvement is particularly noteworthy given the firm's aggressive hiring of managing directors throughout 2024 and 2025. The decline in the compensation expense ratio from 69% to 65.8% is perhaps the most significant indicator for investors. Management has signaled an intention to maintain a similar ratio as the firm enters 2026, targeting the low 60s over the long term, though actual results remain contingent on the competitive landscape for talent and the timing of deal closings. Moelis maintains a capital-light business model that emphasizes the efficient return of excess cash to shareholders. In early 2026, the firm declared a regular quarterly dividend of 65 cents per share. Beyond dividends, the firm's board authorized a new $300 million share repurchase program in February 2026, which has no expiration date and adds to the existing repurchase capacity. Since its initial public offering in 2014, Moelis has returned approximately $3 billion to shareholders, a figure that exceeds its total cumulative GAAP net income over that same period. This aggressive return profile is supported by a robust balance sheet, which as of December 31, 2025, held $509.4 million in cash and $340.2 million in liquid investments, with zero debt outstanding. While M&A is the firm's primary growth engine, its capital structure advisory, restructuring, business provides essential counter-cyclical stability. Moelis has consistently ranked as a top 3 global advisor for completed restructurings over the last decade, having advised on approximately $1.0 trillion of liabilities since its IPO. Restructuring dynamics in a balanced economy. In the current 2026 environment, the restructuring business is evolving. While the volume of distressed debt filings has moderated from peak pandemic levels, the focus has shifted towards proactive liability management. Companies and sponsors are increasingly looking to optimize their balance sheets and address upcoming maturity walls, specifically the estimated $1 trillion of speculative debt maturing in 2028. Moelis's restructuring franchise is defined by several key operational characteristics. In-court/Chapter 11 accounts for roughly 50% of the firm's restructuring mix, maintaining a top 3 global ranking. Out-of-court/liability management (LEMA) accounts for approximately 50% of the mix, focusing on proactive balance sheet optimization. Engagement mix. The revenue base is diversified between approximately 60% debtor-side and 40% creditor-side mandates. Geographic scope. The firm maintains a global footprint with active mandates across North America, EMEA, and the Middle East.
Notable transactions in late 2025 and early 2026 include the €1.8 billion recapitalization of NetSeed Group and a $791 million amend and extend for Acumen Inc. The presence of a restructuring business provides Moelis with defensive characteristics that its purely M&A-focused peers may lack, allowing the firm to capture fees regardless of whether companies are growing or deleveraging. Legal and regulatory evolution, the Delaware impact. A significant development in early 2026 was the Delaware Supreme Court's unanimous reversal of a previous ruling that had challenged Moelis & Company's governance structure. The original 2024 decision by the Court of Chancery had invalidated parts of the firm's stockholder agreement with its founder, Ken Moelis, arguing that they interfered with the board's fiduciary duties. The January 2026 Supreme Court ruling held that the claims against the stockholder agreement were time-barred and that the challenged provisions were voidable rather than void. This reversal provides substantial legal certainty for the firm and reinforces its leadership continuity.
From a broader regulatory perspective, the firm must navigate an evolving global antitrust landscape. While the second Trump administration in the U.S. has adopted a more business-friendly tone and a willingness to resolve mergers through settlements, it continues to pursue aggressive theories of harm in specific areas such as labor market competition and tech censorship. This environment creates both opportunities for deal-making and increased complexity for larger cross-border transactions advised by the firm. Moelis & Company has explicitly integrated technology and artificial intelligence into its growth strategy. This is not just an internal efficiency play, but a central theme in the firm's M&A mandates. Boards are increasingly feeling the pressure to pursue transformational deals to stay ahead of AI-driven disruptions. Management has noted that AI is an accelerant of M&A activity, driving companies to acquire proven tech platforms rather than building internal capabilities from scratch. This is particularly evident in sectors like software, semiconductors, and data center infrastructure. Furthermore, Moelis sees a secondary opportunity in AI-related restructuring. As companies fail to adapt to rapid technological shifts, they may face financing challenges that lead to liability management transactions, a core area of expertise for the firm.
Internally, the firm is investing in AI to streamline the advisory lifecycle, focusing on data and technology to enhance deal execution and client coverage. These investments contributed to the increase in non-compensation expenses in 2025, but they are viewed as critical for maintaining the firm's competitive edge and operational efficiency in a high-velocity deal environment. Competitive landscape: boutique peers versus bulge bracket banks. Moelis & Company's performance is often compared against other elite boutiques such as Evercore, Lazard, and PJT Partners, as well as the investment banking divisions of the bulge bracket banks like Goldman Sachs and Morgan Stanley. The elite boutique premium. Elite boutiques have structurally gained market share from bulge bracket banks over the last decade by offering uncompromised advice and a lack of conflicts related to lending or underwriting. Moelis distinguishes itself through several strategic advantages.
Deal team leanness. The model emphasizes high senior involvement, which contributes to premium fee realization for the firm. Independence. Trusted advisor status is maintained through a strict lack of lending or trading conflicts. Recruitment strategy. The firm aggressively utilizes lateral hires from bulge bracket banks to rapidly expand coverage in key sectors. Resilient business mix. A balanced focus on both M&A and restructuring provides revenue stability across economic cycles. While bulge bracket banks like Goldman Sachs still dominate in terms of sheer prestige and deal size, boutiques like Moelis provide a competitive alternative for mid-cap and large-cap clients who prioritize specialized knowledge and hands-on execution. In 2024, Evercore notably generated approximately $70 million more in financial advisory fees than Morgan Stanley, illustrating the potent threat that boutiques pose to traditional banking powerhouses.
Conclusion. The bull case is anchored in the belief that the current M&A recovery is in its early stages and that Moelis is perfectly positioned to capture disproportionate gains from this trend, particularly through its PCA and AI-focused franchises. However, the bear case cannot be ignored. The firm's high valuation leaves little room for error, and its intense sensitivity to macroeconomic volatility, as seen in the immediate stock price reaction to geopolitical news, highlights the risks of a pure-play advisory model. The robust balance sheet and zero debt provide a critical margin of safety, allowing the firm to wait out market dislocations without compromising its ability to reward shareholders through dividends and buybacks. Whether the firm can reach the aggressive price targets set by some analysts will ultimately depend on its ability to convert its record pipeline into realized fees in an increasingly complex and volatile global environment.